This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to another episode of everyone's favorite podcast, Bank Nerd Corner. I have the queen of bank nerds herself, the banking and fintech editor at Bank Director, Kiah Haslett, making just another fantastic return to the podcast. Kiah, hello.
Hey, how are you, Alex?
I am doing well. I am not in Las Vegas, which is...
Neither am I.
Yeah, how do you feel about that?
Well, I guess that made us available to record today, so I'm feeling pretty good about that. But now that I'm covering fintech more, I am kind of figuring out what's in the zeitgeist.
Right.
And was just seeing how many people are going to fintech meetup. And so I hope everyone had really great meetups and meetings and won a bunch of money if that was on the agenda, or went to cool after parties. But yeah, I did not realize meetup is one of the big events, and I guess now it has to go on a social calendar. What about you?
Yes, ditto. I did go last year, and I'm not going this year because it happens to be scheduled the same week that my oldest son turns 6, and
that's so rude.
Yeah, you don't miss birthdays. So Anil and team at Fintech Meetup, if you could push the schedule around a bit, I'm sure the Venetian would be more than accommodating of that for me specifically. That would be amazing. I also am getting behind a tweet that I saw from Tommy, CEO of Alloy, who said that we can't be going to Vegas twice a year routinely. That's just not going to work. And so he wants the folks at Money 2020 and the folks at Fintech Meetup to get together in a room and decide who gets Vegas and who has to move.
Who gets Vegas?
And I think that's very fair. I mean, whether it's arm wrestling or, everybody goes into the casino with a stack of chips and whoever comes out with more money wins, whatever the competition is, I think we need to settle this because could not be more with them. I'm sad to miss Fintech Meetup, but only doing Vegas once in 2024 would be lovely. I'm actually not going to accomplish that goal because there's another event I'm going to later that's also in Vegas. So I guess I'm not going 3 times, which is something.
Yeah, I think that's good to try to limit I have to go to Vegas for work excuses to a minimum of 2 maybe.
Yeah. My wife just doesn't like that as a sort of explanation, and it just doesn't tend to go over that well. And I don't know, I'm not the world's biggest Vegas fan. Kiah, do you gamble, or are you is there some part of Vegas that really appeals to you?
I've gone to Vegas once before, okay. And then I'm actually going to go to Vegas again in the start of April to see Magic Mike live with my friend.
Excellent.
We've seen it separately, but we haven't seen it together. And so this will be it'll be my birthday trip, and it'll be her baby moon trip. But I'm actually pretty risk averse. I've learned that about myself. And so thinking about taking my money and then just giving it away, but having to make choices, and then only me is responsible for losing my money, fills me with panic. And so I try to do other things in Vegas. I'm really excited about the food.
Yes, good food.
And so that, hit me up with food recommendations and restaurant recommendations, but I don't gamble because I don't like giving my money away.
Fair. That's totally fair. I remember when I was in Vegas for the first time when I was legally allowed to gamble, and I was like, I'm going to do blackjack. This is going to be amazing. And then I don't remember how much money I had, but it wasn't much. It was $200 or something. And I remember getting to the table and they're like, yeah, the minimum is $25 a hand. And I was doing the math. I'm like, so I could do 8 hands? And they're like, yeah. And I'm like, well, that doesn't sound super fun, And so as soon as I found out what the starting level costs were to gamble, I was like, yeah, no, I'm with you. I'll just spend my money on other things. So not missing Vegas. We are missing all our friends at Fintech Meetup. Hopefully,
they're having probably really fun conversations without us.
Yes, I'm sure they are. And there's lots of extra fun things. So we'll try not to let our FOMO seep too much into the rest of the podcast. Kiah, before we get started with the latest in banking news, do you mind if I give a little shout out to some of your work?
Sure. I would love that, honestly.
Let me then say that Kiah Haslett is the author of a wonderful new report that Bank Director just published in partnership with Microsoft on AI, and specifically generative AI and the opportunity for financial institutions. Kiah, I read this report. I loved this report. And the thing I appreciated about this report is that unlike the vast majority of other things that are written at sort of the intersection of banking and AI, this was very, very light on fluff. It was very specific. It provided a great deal of explanation as to exactly what generative AI is and what makes it different. And it had plenty of actual real life tangible examples of banks already using this technology and a very good discussion on how to get started, how to think about it. It was very, very practical. And for anyone in banking that is looking for a primer on all things AI and generative AI, this would be a great place to start.
I really appreciate that. I felt like I spent a lot of time reading AI reports, and I had a very clear sense of what I didn't like in these reports and what I did like.
Yes.
And I have a lot of empathy for anyone who is trying to figure out what their institution, whether or not they work for a bank or not, should be doing for AI. And so all I wanted to do that was make it very approachable and digestible and actionable. And it's funny because I even told my editor, I was like, I don't really want to talk about AI technology because I just think I'm going to lose people. And I think it's going to I don't want to get into conversations about whether like general AI even exists right now. Like, that's a whole thing. That's like a part of the internet. Yeah. So I was really about, I think a lot about how banks make decisions and how to execute. And that's what I wanted to do for this report. So I'm hopefully people find it very useful. And I'm glad that you liked it. And thank you so much for your shout out on this podcast, as well as in last week's newsletter.
Of course. It was my pleasure. Everyone should download it. It was a wonderful report. And as always, read and listen to everything that Kiah does. So with that, Kiah is going to be talking to me about bank nerd topics galore. So let's run through a couple of quick stories before we get into some of the meatier questions towards the end. Kiah, do you mind if I go first?
Sure.
Okay. So this is not so much in the news as it is an anniversary that I have marked on our calendars, but I wanted to wish you coming up a happy 1-year anniversary, roughly, of Silicon Valley Bank failing.
Oh, thank you so much.
You're welcome. You're welcome. And the reason that I wanted to start here is that in a strange way, even though we had known each other before SVB and had in fact met in person at Acquire or Be Acquired prior to SVB melting down, I sort of feel like our sort of professional relationship really was cemented when SVB failed, which is ironic because we happened to miss the news from a timing perspective
completely
with the podcast, which was the beginning of a trend that has continued with this podcast wonderfully. I'm sure crazy banking things will happen tomorrow as soon as we finish recording, but it really did cement for me a lot of the things that I think I maybe took for granted or didn't understand well enough about how different banking things were happening. You were one of the first people to talk to me about like AOCI and, fair value versus financial accounting and mark-to-market accounting in banking. So there were a lot of topics that seemed sort of abstract and nerdy to me months before SVB failed and then became extraordinarily relevant and important for everyone in the ecosystem to understand. And I don't know, it kind of like kicked off like a new phase for Bank Nerd Corner. So I really appreciate that happened, even though obviously it added a lot of stress to a whole bunch of people's lives. I wanted to ask you, reflecting on this a year later, like, what do you remember thinking and feeling in the moment when it happened? And then like, what stands out to you a year later?
It is funny. I do feel like SVB took Bank Nerd Corner to a whole new level of bank nerdery, totally. But also really made people interested in what I consider some of the nerdiest things that I'm interested in. I remember thinking, one, we had recorded a podcast that week, but we missed all of the news, including the balance sheet restructuring.
We did.
So then when the episode came out, it was almost like someone said it was a breath of fresh air that we didn't talk about it at all. And I was like, I don't know if as a journalist, I think that's a compliment, but I'm glad that you found this to be refreshingly naive or like of its own time.
Yes.
I remember thinking, so I had weirdly been talking about AOCI for months at this point, and I had actually said, I think banks need to care about their AOCI and their unrealized losses in the bond portfolio because I believe liquidity is going to tighten, not because I think there's going to be a weird bank run, but because depositors are going to wake up, they're going to start moving some of their money around. And just as that money leaves, a bank should be thinking about how to stay liquid. And normally you would be selling your securities, and they're not going to do that. So what other things do they need to be doing? Like home loan bank, broker deposits, discount window, all these things we've talked about that. But I was talking about it in November 2022. I was also really wanted to write an article about balance sheet restructuring because I thought in November 2022, more banks should be restructuring their balance sheets. So when SVB comes out with their announcement that they were going to restructure their balance sheet, everyone else freaked out, but I was really excited. And I was like, this is the move. It didn't fully register that they didn't raise the capital.
Right.
And then until the next day. And, I'm not in the WhatsApp groups that were talking about pulling all your money out. And so I'm seeing the stock sell off, but without really kind of an appreciation about what it means for the deposits. And that's, I think, something we learned is there's almost no real-time visibility into deposits the way that there is real-time visibility into the stock price.
Mm-hmm.
And so I went from being really excited about a restructuring to being like, I've never seen a bank run or a bank fail because of a run in real time. Yeah. The bank runs predate when I became a bank reporter. Yeah. So it was really confusing to see the bank be closed Friday morning. That, kind of broke the normal failure cadence. Yeah. To fail without a buyer, that was unusual. To go into the weekend being like, well, what does it mean that we don't have the buyer normally covers the uninsured account. Right. They just normally just take them all. And it looked like for the first time, uninsured deposits would take a loss. And I didn't think that was probably great for trust in the banking system. Yeah. I don't know if you remember, but Signature would fail Sunday. And I remember getting a text at the gym that Signature had failed. And I was like, wait, what?
Yeah.
What? I've missed this. And so I felt a lot of sympathy for what regulators were having to do. And they were basically like, there are these teams within the financial regulators that, help close banks. Yeah. And all these teams are getting activated. They're getting activated around the country. And then, for the regulators to know that the regulators didn't have enough time to market the bank and find a buyer before they had to close for liquidity reasons. Right. I remember there was a lot of conversation about whether the systemic risk exception for uninsured accounts necessitated a bailout, which is so funny because when you think about that now, I think that argument has really lost some of its force in it. I don't know if people still think it's important about whether we call it a bailout or not. Yeah. I just, it's just so interesting to see how bank failures are processed and then to see the tack-on effect. So one, I think we saw basically how fast a bank can fail, and a bank that I think was, liked and respected.
Sure, yeah.
We see First Republic fail. And then, when I wrote my article about how to buy a failed bank, William Burgess, the managing director and co-head of Piper Sandler's financial group, told me that the FDIC was looking at its watch. They were not looking at its calendars. This is a really big shift in how the receivership and the resolutions group has to act. And basically their entire timeline got compressed. Right. Then, it was so funny to see all the topics that came out. So the limits of fractional reserve banking. Yeah. You and me joined Jason Hendricks to talk about hot deposits and how uninsured deposits went from being the pinnacle of a relationship that a bank would want with a customer to being the riskiest thing a bank could have is an uninsured deposit. The continued conversation around fair value to financial accounting. Why isn't everything marked to market in a bank? Are banks just should they just be seen as funds that could be withdrawn at any time? Right. And is that the way we should be approaching this? And obviously we've seen in the banking side, some of the reports about the limits of supervision, whether the supervision feedback was effective. And then obviously, we're still grappling with regulatory fallout at the failures happen as the Federal Reserve is talking about higher capital requirements. Yep. And then also the FDIC has come out with governance proposals for banks that are above $10 billion in assets. So it's just kind of trying to figure out how do we make sure this doesn't happen again, but also not that we become so myopic that we miss the next crisis because, obviously bonds and uninsured deposits, I don't think was on anyone's bingo card for 2023 stress. So I don't know. Is that a good recap?
That's a great recap. That's a great
okay,
recap. No,
good.
That's perfect. The only thing I would add to that is, as you were describing that, it's really interesting because it was sort of like there was this slow moving train that anyone who was sort of paying attention to banking could kind of see.
At SVB, you could see it.
Yeah, right. So I mean, again, to your point, balance sheet restructuring. Interesting topic. I wonder if I could get anyone interested in, reading about that. That's kind of interesting. This is something that's observable across the market generally. Another thing I was sort of struck by that I certainly wasn't paying attention to before SVB, but it's become a big topic after, is how sort of mechanically unprepared SVB and lots of other banks were, right? Because I guess, you're not in sort of crisis mode. And so you're well, I'm sure if we need backup liquidity, FHLB will be there. The Fed discount window, how hard can it be to, transfer collateral? There's all of these mechanical elements, even like the uninsured deposits. Like, well, we're a member of the IntraFi network, and even though we haven't really like pushed any of our customers over to reciprocal deposits, that doesn't mean that we can't. And like it was like they were this close to the edge of like a very, very stable foundation that they could just step over to. But to your point, the fact that they had drifted a little bit away from that in terms of their balance sheet, the mechanics of how they manage liquidity, all these different things, the fact that they drifted just far enough away, and then to your point, the incredibly unique things about SVB, and to your point about the WhatsApp group, I wasn't in any of those myself either, but I was sort of like in the next level of groups right outside of that. And so
you heard that this was being talked about.
Yeah, and I kind of was getting some like weird signal, and I remember thinking like, I don't know that there are a lot of other banks that have such a level of coordination among their customers. And so it was one of those things where it's like this slow moving systemic problem. And then like it gets hit by a bolt of lightning, and then like the train explodes. And you're like, well, okay, that was kind of weird. And the fallout from it was actually fascinating. I'm glad I wrote about this actually, because I wanted to memorialize all the stupid takes that were happening that weekend. And folks in the venture capital community were the primary contributor to a lot of those stupid takes, and probably wish that they could delete some of those tweets, but I have screenshots of all of them. So I think it did definitely drive home this understanding that there was like an undercurrent of like really nerdy bank problems that bank nerds like yourselves were paying attention to. And then there was everyone else who sort of sits on top of the banking infrastructure, including some regulators, by the way, who really weren't paying very careful attention to those problems. And like the lightning bolt hitting it in March sort of caused everyone to wake up. And, I think we're still feeling, to your point, the reverberations of all of that happening. I mean, obviously there's lots of different kind of rulemaking and sort of proposals that are being batted back and forth. There's been a ton of academic sort of research that's come out since this happened, trying to help us understand the limits of different types of deposits and how they should be classified and how they should correlate to different types of risk. And, there was even a brief discussion about maybe we should have narrow banking before we decided that that would be bad for capitalism. And so there was all of these sort of, I think, probably pretty useful debates to have. And I'll be curious to see long term how long it'll take us, to your point about preparing for the next crisis, for us to forget some of these lessons. Because that was the other thing I was sort of struck by with SVB was it's not like we hadn't had this problem in the relative rear view mirror. Like it was relatively close. But to your point, you weren't a bank reporter then. There were lots of people who weren't chief financial officers at banks then. There were lots of regulators who weren't in senior supervisory positions then. And so it is amazing how short our memories can get on some of this stuff, because it was a combination of sort of novel problems and then sort of well-established problems that we already knew about. And that confluence seemed to catch us off guard. So no, I find it to be a very interesting thing to reflect on.
I hope everyone will remember the next interest rate cycle we're in, that bond yields fall as interest rates rise. Like that's all you need to remember. Yes. It really will help you with a lot of the balance sheet stuff.
Yes.
And then the other thing too, and to your point about forgetting the lessons of a crisis, you're mentioning, you're alluding to like, the savings and loan crisis, or you're alluding to the start of great financial crisis. I think we kind of forgot that we did have COVID as a financial crisis. Like for a while, COVID, it was a big economic crisis, but like when the economy shut down, banks were wondering what they were going to have to do. And if, we were going to have a lot of credit issues and things like that. And I remember at the time thinking like, the only thing you can't buy in a crisis is time.
Right.
So you have to have a lot of things in place before you need them in order so that you are prepared for crises. And so, you want to have robust stress testing. You want to have good metrics on your borrowers so you can quickly process loans, or you can put them into modifications if your regulator allows you to offer broad modifications. But you also want to make sure that you have like backup liquidity, and being close to liquidity is not the same as being liquid. And then to understand that, like, I remember you and I talking about this, that the government bonds are safe from a credit perspective, but they are often carry a lot of interest rate risk. But the interest rate risk only kind of gets realized if you buy a bunch of them, when interest rates are really low. Yeah. And so it just was really interesting to kind of think about, how do you see risk building? And then what in your brain indicates that something is safe or something is a risk? And what would have to change to make those two dynamics shift, right? So hopefully we get some really interesting things coming out of the fallout from SVB, but I think also, it's great that regulators were pretty successful in stabilizing the banking industry. I think, props to them for doing that. Can't thank anyone on the venture capital space for hyping up.
They were preparing America
liquidity
for like Armageddon on Monday, and then like that didn't happen. And I don't really remember those VCs apologizing to Janet Yellen or any of the other folks who were like actually trying to solve the problem. So yeah, I mean, I think as another fallout from that is just spend less time on Twitter, which I've failed at. I have not succeeded at that resolution, but that was definitely the moment where I was like, oh my God, I'm way too addicted to this app. Kia, speaking of drama that's playing itself out on Twitter, among other places, can you jump us to our next story?
Yeah. So I feel like everyone's talking about this except me. So let's talk about it. Banking as a service has seen some movement, some announcements. I think it took up a lot of oxygen in 2022 and 2023. And it feels like we're kind of getting to a next phase in this business line. I know you wrote about it last month, but we've been waiting for this shoe to drop, which is the regulators saying exactly what they think about some of the changes we saw in banking as a service from 2022. And it looks like they don't like it, as evidenced by enforcement actions against Lineage, Blue Ridge, BaaS, WEX, Metropolitan. And then, in response, there are banks that I would say are kind of new entrances to the banking as a service space that have decided to either substantially pare back or exit it, including, the banks that I just mentioned, Lineage, Metro, BaaS, exiting crypto, and a big pullback from Blue Ridge. And then we've also seen some changes in the outlook for the middleware providers that facilitated some of the new entrances from the banks, including, Treasury Prime shrinking and pivoting their focus, Synapse shrinking after losing one of their largest fintech clients, Unit losing one of their bank partners that is offering direct partnerships. But we also see, is it Synctera? Is that how you pronounce it?
Synctera, yep.
I never know. Synctera. Okay. They just announced a new funding round and appointed a chief risk officer. So there's some shifts on, I think, the appetite and the demand, and I think the ultimate focus that these companies are going to have to adopt in order to survive and play longer in the BaaS space. What about you? What are your takeaways from seeing some of these announcements come out in the last month?
Yeah, it's funny. I remember at Money 2020, the conversation that was happening sort of in the hallways and behind closed doors was basically that regulators were applying a tremendous amount of scrutiny to banking as a service generally, and to some specific models within banking as a service more specifically. And the takeaway from that I heard from multiple folks was there are models that are sort of well used and well liked in banking as a service today that have been around for now at least a little while, that regulators are essentially, I mean, they can't tell banks what to do, but they have essentially said, we're going to make your life a living hell if you do this, right? Like here's door A, you can do this. Here's door B, you can also do this, but it's really going to suck. And everything I've seen since then has indicated to me that that's exactly what all the prudential regulators, so OCC, the Fed with their novel supervision program, the FDIC, they all seem to be singing from a similar hymn sheet around certain models in banking as a service, particularly the ones that kind of disintermediate or sort of provide an abstraction layer between the bank providing banking as a service and then the non-bank clients that are utilizing it. Those models are just kind of getting a tremendous amount of scrutiny right now. And I don't think that long-term those models can survive the way that they have been historically. And, it's interesting because the question that poses to me is, what are the ripple effects of that? And the big one that I've noticed, both on the bank side and on the BaaS middleware, and then even just the fintech side, is you really can only do this if you're serious. And I think that's kind of like what's happening at a 30,000 foot level is if you're serious about doing banking as a service, then what regulators are going to expect you to do is invest in the infrastructure necessary to do it well. And that means people. And I've heard a lot of banks that are going through exams being told that they simply don't have enough people on staff to handle the number of programs that they have. So
Yeah.
you need to have more people. You need to have more rigorous processes. You need to have technology set up. You need to document every single thing. Even if you're doing everything exactly right, if it's not documented well, you're screwed. And so everything is just getting harder and more expensive for banks that want to be in this business. So if you're, I'll just pick on Blue Ridge as an example, a little bit more recent entrant into the space. And again, I haven't spoken to anyone at Blue Ridge who was involved in these initial decisions, but my sense watching them from the outside is that they kind of viewed banking as a service as an easy button from a revenue and a growth perspective. And that's kind of how it was sold to them by a lot of the folks in the space who were trying to sort of enable banking as a service and sort of get enough supply to meet the demand that was happening. And it's just not. And so regulators have
Yeah.
basically said this isn't an easy button. If you want to make this a business line for your bank, if you want to make this a major part of your business, you have to invest in it like it's a major part of your business. And if you don't, you have to
Yeah.
get out. And the fact that Blue Ridge has gotten 2 consent orders from the OCC in less than 18 months, I think is a pretty good indication of, I don't even really think the OCC thinks that Blue Ridge should be in it at all. Like,
Yeah.
like, no, you don't just get to kind of back away slowly, but still keep some of the partners that you really want to keep. Like, you either have to get all the way in or all the way out. And
Yeah.
I'm seeing that across a number of other banks and providers. And then by the same token, on the fintech side, I think that we went through this period of mania where there were so many new fintech companies and so many new sort of founders that were looking for bank partners that were all backed by sort of ample venture capital during the ZERP years, that they had this like expectation that no matter what the sort of shape of my business or how promising it is or how much money I've raised or how much money I'm making or how many customers I have, I should be able to get a bank partner and get up and running really quickly. And
I should.
and
Yeah.
that's
I love that.
yeah, I mean, and like why can't, essentially the attitude I think was, why can't I spin up a bank the same way that I can spin up a server with AWS? Right? Like if I can
Right.
spin up a compute environment with just a couple of clicks and adding my credit card, I should be able to do the same thing with banking. And AWS for fintech was and continues to be sort of a popular metaphor, but I don't think it's a very good metaphor because that's just not how the regulated side of banking works. You can't just spin it up like that. You can't abstract away all the complexities and just give something to developers. And so now what fintech companies are finding is, hey, that's fine if you want a banking partner. There's still banks that are doing banking as a service. There's still plenty of banks that are, signing up new programs and are trying to grow. Obviously, you mentioned Synctera getting a extension on their Series A and, continuing to invest in this space. Like, there's ways to do this still. It's not like BaaS is dead, but what fintech companies are finding is if your program and your business is not sufficiently large and attractive, you're not going to get any bank partners. So there's kind of this higher floor that fintech companies need to get to before they can get a bank partner who's reputable and who can take on new programs to be interested in them. And so both on the bank side and the fintech side, there's kind of this higher floor to be in the space than there used to be. And then for the middleware platforms, as you said, I think everyone is in the midst of pivoting from a model that said fintech companies are our clients. That's who we focus on. That's our customer that we're trying to serve. That's what we're building our technology for. To what you've seen Unit talking about recently, what you've seen Treasury Prime kind of pivot more strongly towards with this most recent announcement. They all are now treating banks as their core customer. We work with banks. We enable banks. Banks are our customers. And I think that's a direct reflection of the fact that, regulators have said, if banks aren't doing this in the right way, none of the rest of what you're doing matters.
Yeah. It's been so interesting to cover banking as a service from the bank perspective. One, everything I'm about to say is my own opinion. It's always my own opinion.
It is always his own opinion on this podcast, just to be clear.
But I've been covering banking as a service from not the technology perspective, but I knew about it from the Bancorp. And famously, the Bancorp, like if you guys are wondering where did all my nerdy deposit knowledge came from, it came from the 2016 or 2014, I think it's 2014 order that the Bancorp went under, and then they had to reclassify all of their deposits as broker. And I basically started learning about this.
Yeah.
But that order took 6 years for them to get out. I think the Bancorp was like pretty into banking as a service, but when they got that order, but basically, I believe, that order made the Bancorp say, this is what we do now. We do it really, really, really well. Mm-hmm. And it was really expensive and it took them a really long time. And then I remember learning about the existence of the middleware providers. And I was like, wait, what? That's something that, I mean, it made sense that it exists, but I was like, that just doesn't smell right.
Yeah.
Like that doesn't seem like something that I've heard other legacy BaaS banks do. And, I just see, it was, I guess, worth a try, but these are very expensive, mistakes to make in orientation. And it just also didn't seem like, I'm glad that they all tried, but it just didn't seem like they were really being like, what do regulators care about? And they're, I believe that there actually was evidence from these 2 orders that the Bancorp underwent for banks to know what regulators expect.
Yeah.
It just wasn't. I do think there was some easy button energy. And I believe, if you're going to do banking as a service, this is your identity. You need to change who you hire. Like you need basically 40% of your staff needs to be devoted to compliance.
Yeah.
With
you
this
need to
program
reorient
in some
your
regard,
entire
compliance and
business,
risk.
right?
Yeah.
And it's compliance. To use Treasury Prime as an example, a big part of the pivot that they're making is away from trying to help banks sell to fintech companies. But during the boom years, that was a big need that banks had, right? As they were getting into the space and they're like, hey, we don't know any fintech companies. We need you to introduce us to fintech companies. We're getting on the phone with these fintech companies and we're not closing the sale because we don't know how to talk to tech companies or startups. And they think we're this weird bank that's asking them these questions. Can you get on the phone with us and help us do that? Can you help us close these deals? And that became a big business for Treasury Prime and a whole bunch of others, but it was so specific to that environment, right? I think it's such a good point that Bancorp's been doing this forever. Meta, which is now Pathward, they've been doing it. This, banking as a service grew out of prepaid, which had been doing this type of stuff, these innovative programs for a long time. It's just that the demand side of it was so small. There weren't that many companies that were trying to create a neobank. And then all of a sudden, 2019, everyone is trying to start a neobank at the same time. And so the market for BaaS, the demand for BaaS shoots through the roof. And I think there were all these banks that were like, look at all this business that's just available for us to pick up. And it's that kind of environment where you get those easy button answers. And it's just, it's not that easy. Now, I will say one thing you added to our outline for today's podcast, which I'm glad you included, is there probably will be some, I think, long-term benefits to us going through this sort of mania period and then kind of dealing with the depressive episode that's happening, I guess, right now with banking as a service. But it's really important, I think, that a lot of this infrastructure and these processes get upgraded. And so RegTech is one that I've written about a lot. I'm sure you've been looking into it as well.
I'm about to start writing about RegTech.
Yeah. I mean,
it's
there's Hummingbird, there's Cable, there's Themis, there's Alloy, there's Sardine, there's all of these companies that sort of work in compliance, fraud, wherever, and they're building better technology for banks to manage compliance and making sure that what they're doing and the controls they have in place are going to work. And I actually think that's a nice upgrade for the system overall, regardless of whether you do banking as a service or not. And banking as a service turned out to be, I think, for those companies, kind of the urgent first problem and test case for their technology. And so I think in a lot of ways, banking as a service was a very nice sort of incubation lab for a lot of great new technology in regulation, compliance, fraud, just sort of general
CIP,
automation.
customer due diligence.
Yeah, customer due diligence. There's all these areas where that technology upgrade, I think long term will be really useful. The other thing I was wondering about, Kiah, and maybe we can end this story on this one, is I also think BaaS does bring to mind a really important topic, which is, and it kind of goes back to what I was saying about the floor. Okay, so say there's a fintech company that's not meeting the floor that banks now have for which programs they'll work with. Well, what does that fintech company do? Where do they go? And that's a question that I'm kind of getting obsessed with right now because it touches on other things that I know you and I are both very passionate about relating to the de novo charter process and the creation of
they get money
banks
transmitter licenses. They have to go to all of the states and they can get the one application, get 20 states and then they gotta get the 30 other ones.
What is the alternative path for a person who has a really good idea for a bank thing that should exist, but can't sort of meet this new minimum standard that we have in banking as a service? Where do they go? And I think that is a question that I hope comes out of all this sort of BaaS sort of drama right now. And I think that regulators should engage seriously with that question and not dismiss it because,
Yeah.
I mean, like we talk all the time about what a sort of competitive market for financial services the US is and the benefits that you get and like, wow, look at all these choices customers have. But if we sort of restrict any ability for new entrants to get into the market, whether it's banking as a service or a charter or going and getting state licenses or whatever it is, like if we raise the barriers on all of those areas, we are cutting off our ability to have a really competitive environment and all of the sort of attendant advantages to that. So that's the other kind of big picture thing coming out of this that I hope we talk more about.
Also, I do try not to scoop myself on your podcast, but I do wanted to say, like, your assertion about the reg tech and how I personally think the BaaS banks have shown the risks that can come from technology. But if you think about, all banks have really invested in technology and digital account opening and account processes and things like that. And so I think that all banks should pay attention to the consent orders that the BaaS and the tech banks receive, because they actually have similar problems, just not to the same degree, not the amount of accounts that need potential remediation or compliance issues. And so I've looked at all of these consent orders that the tech banks got, but also our tech issues at not BaaS banks. Because, AML comes up for a lot of banks in a lot of places, and it's not just the BaaS banks, it's because digital banking has made it easier for different types of customers to enter into your bank and open an account. And so I think about the BaaS banks as being kind of like the canaries in the coal mine. And so what the issues that they'll get are issues that other banks can expect to, have brought up in examinations.
Yeah, no, I totally agree with that. I think BaaS is presenting a very nice preview of a lot of issues that we're going to have more broadly. So among other things, it's been very useful for that, very educational for both of us. Kiah, can we do one more news story before we get to my question?
Sure.
Okay. Would you prefer to do a Supreme Court case or would you prefer to do a merger that is related to
It's funny because both of these ideas are about Durbin.
They really
Do
are.
you think that we need to give our takes about the Capital One Discover deal, which we also missed the last time?
No, I know. Yeah, we missed it by
Or should we talk about Corner Post versus the Federal Reserve?
Yeah, we missed Capital One Discover by a week. Let's do this. Give me your 30 seconds on Cap One Discover. Go.
Okay, so this is more of a rant, but I think that I just want to congratulate whoever lobbied for the carve out for the networks on the Durbin exemption. Nice job in 2011 doing that. And it has created a very interesting dynamic for this deal. And honestly, thank you so much to Richard Fairbank for pointing out that this would be a major competitive advantage if the deal is approved.
Yes. Okay. That is an excellent one. My quick take, which I've already written about in the newsletter, is I'm very curious to see the degree to which, if this deal goes through, Capital One is able to exploit the unit economic advantages they will get by owning their own network. And debit cards is easy because they don't really have much of a business that they have to viciously defend, or there's not taking a lot of risk necessarily to move over their debit cards. Credit cards, I think, are much more interesting because I'm not sure they're going to move everything over, and the portfolios that they do move over and how they choose to exploit that, whether directly or through co-brand relationships, will be very interesting to me. I'm very curious to see just how sort of Amex-like they try to become on the credit card side, assuming this deal goes through. So those are our quick 2 takes on Capital One.
Those are 2 takes.
And Discover.
Yep.
Super fast. Kiah, was unusual for us. Now give us the quick 411 on the court case.
Okay, so this is also related to Durbin. It's Corner Post versus the Federal Reserve Board. This case was argued before the Supreme Court on February 20th. It is about the statute of limitations for judicial review of federal agency rulemaking under the Administrative Procedures Act. So the background of this case is that Corner Post is a convenience store in North Dakota that was incorporated in 2017 and began operating in 2018. They are asserting that the Durbin Amendment harms them, but the Durbin Amendment, by that point, the statute of limitations had expired. There was a 6-year statute of limitations by which companies could sue that they were being harmed under the APA. So this case is not about Durbin. This case is about the APA. Corner Post is arguing before the Supreme Court that they should be able to, the statute of limitations should in fact be when they were harmed by a federal rule.
Oh, interesting.
Versus when the federal rule went into effect. And so that's what the Supreme Court is going to hear, this like statute of limitations when a federal agency, in this case, the Federal Reserve, makes a rule. So in this case, Durbin, and when that limitation expires. But I just thought it was really interesting that it had to do with Durbin. As far as I can tell, and it's not clear, I believe this convenience store they think that the swipe fees are too high on Durbin.
I was going to ask, like, what's their problem? Like, Durbin's good for you guys.
Isn't it funny that like we talk about Durbin being like it's like too low for banks, and then this is like this company is arguing, and the North Dakota Retail Association is arguing that Durbin is too high for debit interchange. Like he's not even like saying like, you know, $20 minimum for credit cards. Like they're saying that the interchange is too high on debit cards. So it's not clear. Like there's another rule or another court case that's challenging directly the Chevron doctrine. Right. This case is related to the Chevron doctrine, but it's not Chevron doctrine, it's APA. But I just think it's kind of funny that the Supreme Court might say that the statute of limitations in this case began when the store received the harm. Yeah. And then I guess that would then kick this court case back that the convenience store can sue the Fed for harm. But it's funny because like maybe they should just wait for like the Federal Reserve to lower interchange again and do it every 2 years, right? Like this court case might take care of itself. But it's just funny that Durbin is what the rule underpinning Durbin was argued before the Supreme Court this last month.
That is very interesting. And I do think one of the things that's kind of fascinating about Durbin is it makes for, and we're going to rant about this later, but it makes for sort of strange bedfellows a little bit, because I think no one can really decide in like the political arena, whether it's people in Congress or Supreme Court justices or whatever. It seems like no one can really like ideologically decide whether they want merchants or banks to have more money. And so like everyone gets all kind of weird. Like
consumers are just out of this.
Yeah.
Someone's got to get more money. It's banks.
They totally are. Right. And it's like, you know, I mean, it's like, you know, if we were to abolish the Durbin Amendment, would like completely free checking and rewards debit cards reappear? No, I don't really think so. You know, if we further sort of tighten the screws on Durbin and cut these fees even more, is that money going to flow to consumers? Definitely no. We know that's not going to happen. And so like, it's not about consumers. And it is this really weird like Rorschach test for like, do you think merchants should have more money or banks should have more money? And people don't come down on that the way that you would think. So I do find Durbin to be a very interesting wedge into these other issues, because on the surface, yeah, it's about the Administrative Procedure Act, but like the wedge issue that's driving people to think about it is this highly like controversial amendment that still kind of continues to haunt everyone in the ecosystem. So no, I find it fascinating. We're going to return to Durbin and interchange and other topics at the very end when I let Kiah rant about one more thing. But Kiah, before we get there, can we spend a few minutes on an unanswerable question that I have?
Sure.
So my question is this: why are branches still important? And I'll tell you why I'm asking. And I know you've done a lot of like reading about this topic, so you can add in some additional.
Yeah, Bank Director has written about branches a couple of times.
It's come up. It's come up, right? Yeah. And like this is one of those ones where we actually have pretty good data on it. And so I'm going to just give some stats real quick and a little bit of insight, and then I would love your sort of answer to this question. But a couple things. One, the overall number of branches continues to sort of go down, right? So you see you added in some notes here in the outline. According to S&P, a net of 1,409 bank branches were closed in 2023, which compares to less, I guess that's less than previous years. It was 1,854 in 2022 and 2,928, the highest on record, in 2021. So there's this very sort of strange dynamic in banking from a branch perspective where overall the number of branches are going down. That's like the big trend line. However, that down arrow is not like just a cliff that everything is falling off of. And in fact, the pace of branch closures is going down, not because all banks aren't still closing some of their branches. They are. JP Morgan Chase is closing branches. There's all kinds of banks that are closing branches. But banks are also building new branches. And so we saw that PNC announced recently it was committing about $1 billion towards opening over 100 new branch locations through 2028, as well as renovating a bunch of existing branches. JP Morgan Chase is going to add over 500 branches by 2027. Fifth Third is another one that I've seen talking about branches as an expansion strategy, particularly in the Southeast corridor where they're really trying to grow their business. So there are like very large, and I would say very smart banks that look at branches and they don't think they universally should exist everywhere. They're still closing them. But the way they talk about it is we're not cutting our investment in branches, we're optimizing our branch network. So we're going to add branches in places where we think we need them. And then we're going to maybe optimize or cut back on ones where we don't think we need them. But like the net is we are still going to be investing in branches. And I find that very fascinating.
Why? Wait, why do you find it fascinating?
Well,
like what? Like, because branches are a very time-honored distribution channel for banks. So why do you find it interesting that banks would still want to invest in branches?
Well, fundamentally, and I'll compare it to a different sort of area that intersects with financial services. There's nothing I need to do mechanically as a financial services customer that requires me to be in person. Nothing. Zero. Nothing. And financial services is ones and zeros, and it has been for a long time. So there's nothing I need to do in person. And for the most part, as a consumer, I find branches to be kind of a pain in the ass. Although I did take my eldest son into a bank branch for the first time because he got a check for his birthday, and we went to cash the check, and it was
that's amazing.
It was pretty cool, actually. It was kind of fun, and he like gave it to the teller, and then the teller thought that we filled out the deposit slip wrong, but it turned out the teller was new and didn't know what they were doing, so I had to correct the teller on the procedure.
Nice.
It was a whole thing. But
good branch experience.
It was. Yeah. I was like, turned to my son. I'm like, these are branches. This is what this is like. And like, I've sent like wire payments that I've had to go into the branch to like fill up paperwork for. So like, it is sort of a charmingly old fashioned experience at times. But like, if all the branches in my community disappeared tomorrow, I would be fine. Nothing would like meaningfully change for me. And I think broadly speaking, that's kind of what separates sort of core banking from other areas, right? Like I'll use auto lending as an example. Folks have tried to disrupt the automotive space for a long time with digital only models. And, you have Carvana building like car vending machines and stuff, but it never really works. And the reason for that is that car dealerships exist because you don't want to spend $30,000 or $50,000 or $80,000 on a car that you've never gotten to touch and see and drive before you buy it. So like, fundamentally, some version of car dealerships are always going to exist because cars are a physical product. Financial services, kind of core banking stuff, not the same. So I don't think branches need to exist. And the fact that they've been disappearing at the same time that digital has become more prevalent and interstate banking has become sort of the norm, like given the trends over the last 30 years, the fact that bank branches have been going down overall as a trend sort of confirms my hunch that bank branches aren't really necessary. And so that's my perspective on it. But then, they ask Bank of America about this in their latest earnings call, and they say 600,000 people a day walk into a Bank of America branch somewhere in the country. That's a large number.
So many.
The CFO of JP Morgan Chase, when talking about adding more branches and investing in branches and optimizing their branch network, says, we have observed over a long period of time that branch share and deposit share are quite strongly correlated. But again, as we were just talking about with SVB, a lot of the things that we think we know about deposits and how they behave and some of these correlations might just be things that are historically true but aren't necessarily true anymore. And then the last thing before I hand it over to you, Kiah, is I do also think there was this study that you pointed out to me done by the Federal Reserve Bank of Philadelphia that was sort of looking at the relationship between U.S. bank branch closures and banking deserts, meaning places where there's a sort of lack of banking services available to consumers. And that survey found that between 2019 and 2023, the total number of bank branches declined by 5.6%. The number of banking deserts increased by 217, and the number of Americans living in banking deserts grew by 760,000. So the Fed is pointing out there that, again, might be correlation, might be causation, but as we are closing branches, particularly in rural communities, there is a corresponding increase in sort of loss of access to essential banking products, oftentimes in those same communities. So there are all of these, I guess the thing that's weird to me is there's all of this like data, but everyone kind of looks at the data and disagrees with it. Very smart bankers will look at this and go, well, no, we still need branches, and here's all the reasons why. But bankers were also saying a lot of things that they knew to be true before SVB melted to the ground that turned out to maybe not be quite so true. So I have a really hard time parsing this one, even though there is ample data and studies to draw from when trying to figure this out. Kiah, what the hell?
So, like I was joking before, branches is something that Bank Director has spent a lot of time thinking about because our readership, who are also bankers, think about them a lot too. And so it is a very important historic legacy distribution channel. And I think, for me, the question is, what role will branches play going forward?
Yes.
And how can you update your assumptions about the best way to reach customers or provide banking services in a way that maybe uses branches to some degree, but maybe not to the same degree that we had historically, maybe even 10 years ago. That's how much I think evolution has happened. Something I like to think about is, the population has shifted in this country. And so it kind of makes sense that there would be some rationalization of the branch network. Branches are also really expensive for banks to operate.
Yeah.
And so this is an area where they can close a location, shift the employees around, but still keep the deposits. Yeah. And I think that's really important too. I've been thinking a lot about the type of account that comes through a branch versus the type of account that comes through to a bank through another way. Yeah. And we saw this in SVB. Mm-hmm. There is an NBER paper called Bank Branch Density and Bank Runs. And they kind of know how the story ends because SVB fails. And famously, SVB had 10 branches. Every branch at SVB had very big accounts. But as you go through normal banks that have just a normal branch distribution channel, that the more branches you have, the smaller the accounts tend to be because you get retail accounts. And I was thinking about how important it is from a retail account perspective. If you are going to try to compete for retail accounts, they are small dollar, they tend to be insured, they tend to be really sticky. Yeah. And right now, I think that those are increasingly important characteristics of deposit accounts. And so it makes sense to me that banks would want that stable money, but you also want the customer account in maybe the areas, the new neighborhood development, right? Or these towns, I think about in Tennessee, towns that were more rural maybe 10 years ago, but as Nashville has gotten more expensive or Davidson County has gotten more expensive, people are kind of moving to those towns and they're getting developed. And so you might want, and there will be some small businesses and maybe a restaurant to support them. And you would want to maybe enter that to try to get deposit share through a branch in a way that online account opening won't be as effective.
Well, can I ask you a question about that? So I think about that a lot too, right? Is how do you acquire customers? This is sort of a really we're getting down to the bare metal here, but
it's so meta here.
It is, but it's I think about this a lot because there's a new neighborhood or a new sort of expansion of a community that you're oh man, this is really good banking business to go get there. I'm going to build a branch. I'm going to build a branch there and then I'm going to get deposits, retail deposits, fully insured deposits, sticky deposits, sleepy deposits. How? Yeah. What is it that you I mean, honestly, one of the things that comes up sometimes when you talk about branches is it's literally just a billboard that I drive by every day. Is that it? I'm trying to rationalize because as someone I don't think of myself as too old, and I like to think I can at least put myself in the minds of people my age or younger, demographically, I would think that most of the growth in the future will come from people who wouldn't necessarily think it was the most logical thing to do to walk into a bank to sign up for a bank account. But it's also been a while since I was 18 and I got my first banking account, which I did open in a branch. So maybe, I don't know.
Where did you open your kid's account?
Where would I open my kid's account? That is a great question.
Did you open it at a bank you currently bank at and two, a bank you are physically close to?
Yes. Oh, there's balloons on the screen that went up just as Kiah did.
I don't know what that is. This is your
people listening to that. Yeah, I don't know what happened with our recording software, but balloons just went up. Kiah won the argument there. That was interesting. Yes, I did.
But why did you do that?
Well, that's a good question. Two things. One, I would recommend my bank to my kids because I'm happy with my bank. So that's just word of mouth, whatever. But the in-person thing or the close thing, I guess for me, and maybe this does touch on a part of it, for my kids, I kind of want them to in the same way that they can learn stuff online, but I sort of want them to go to school. I kind of want financial services to be a physical lesson that kind of gets imprinted on their brain. When I took my 6-year-old to the bank, it was cool to go to the parking lot, get out, walk into the bank, and he got to see this is a bank, that's a vault, that's where money is. Of course, there is no money in the vault. None of that is true, but like it's the impression it makes on you when you're like first engaging with financial services. And you're pressing on a really interesting point here, because this ties back to the banking deserts thing, right? Why is it that when you close branches, seemingly it creates banking deserts, particularly in like rural communities? And I think that's a really fascinating question, because this isn't 1998. Like those rural communities, no matter how rural they are, have the internet, right? Like, I mean, internet penetration is
ostensibly. I think there's a question about broadband access, but that is not something banks have like really any control over.
not.
That is a government problem that the government
Yeah,
could
talk
solve
about like
if they
wicked
wanted
problems.
to,
Like
right?
that's not for banks to solve, but certainly not for fintech to solve. But like it's kind of like the number of underbanked folks in the US. Are there still folks who are underbanked? Yeah, but like it's a pretty small percentage. It's the same thing with internet access. Like, are there places in the country where there's not as good internet access? Yes, but reasonably speaking, if you were driving 30 miles to a branch, probably you're going to have relatively comparable levels of internet access in that same community. So, what is it about those branches disappearing and these communities just no longer having any physical banking infrastructure that causes banking services to be less accessible in those places? And maybe it is kind of the same thing I was talking about with my kids, where like there is an element that's kind of hard to describe with financial
Yeah.
services that needs to be physically present. I'm not sure what that is, but it does seem like there is
Yeah.
something there.
I do think that, so the question about branches is so interesting because as more financial services have moved online and people have a lot of comfort with that, and it is interesting to ask, what do you need from a physical bank? And why would I choose one physical bank over another physical bank? I think the other thing too is that famously people don't close their bank
Yes.
accounts. I think about when I have changed banks in the course of my lifetime, oftentimes I was moving. I was physically moving to a new place, and I felt that I needed to have access to banking services in that new place, especially if my bank didn't offer good digital account services. I will say now, maybe, let's say like I was at Wells Fargo and I had a friend that moved to DC and she was a Chase customer. Chase didn't have a lot of branches there. So she actually moved her accounts from Chase to Wells Fargo. Yeah. But now I'm wondering if, Chase has her credit card and maybe sees that she lived in DC, and Chase is like, well, we don't have a branch there. We should open a branch because we know we have customers there. We have this card data and we think we could get their deposits. They might transfer them back, but also maybe there's a small business customer and we could offer them a credit card along with a loan, along with the deposit services, just because we're physically present. You could apply for a loan probably online, but even the physical presence and seeing that might make the banking customer, move their accounts or open an account. I do wonder, what are we supposed to do if there is a banking desert? It's not like in a food desert where there actually is no food for sale. Like you could still have the penetration of financial services online. This kind of gets at, for me, one of my like long-running pet peeves is that I feel like we have really, really good data on physical branch locations, and we have sort of good data about the deposits that are attributable to each of those locations. But what I don't think we have is deposit share nationally at banks not tied to branches. So like I bank with an online-only bank. Bank has one or two branches in the country. In the summary of deposits data from the FDIC, it is possible that my deposits in Nashville are attributed to a branch that is in like Utah or California or something. And so does the FDIC think that I live in a banking desert, or understand that my relationship with financial services isn't tied to branches in my market, but is tied to is an online relationship to a bank elsewhere? I think that that whole question is something that we've seen is like why it comes up a lot in bank M&A, that like the regulators can really easily figure out the deposit market share between two banks that want to acquire each other. They're less good at incorporating credit unions. They're not that good at incorporating digital banks. They're not that good at figuring out how much financial activity is happening on Cash App, right? So the question is for me, are these deserts truly deserts? What kind of options are available? Also, what are we missing when we look at the data cut this way and defined this way? And I think that deposit data is increasingly not a really, really useful way when applied to geographic tracks. And this might actually get changed in the new CRA bill. There might be a way for banks to get credit for online financial services activity outside of the bank. But it's just so interesting. This is such a legacy thing to look at. Geography plus physical location equals financial access.
Well, and to flip that around a little bit, I mean, I think the other thing that's really interesting about this sort of geography question is if you're an online only bank, so your Cash App, your Chime, your whomever, what differentiated strategy are you applying to go acquire customers and acquire deposits? And how connected is that strategy to a geography or a region of the country, right? Because if you look at like the growth of P2P payments, just as one example, what you would see is that all of the different P2P payment networks actually started in different parts of the country and sort of virally spread through those parts of the country to become sort of nationally sized and scaled up P2P networks, right? So, Venmo sort of took root on the East Coast and on the West Coast and sort of expanded from there. Cash App, by contrast, really started in the Southeast and kind of grew out of the Southeast. And, there is no real reason why those products sort of became concentrated in those places. They just happen to be. And so I do think it is really interesting to sort of look at like what drives a business that doesn't have feet on the ground in a particular community to focus on acquiring customers in a particular segment, and where might that segment actually be located, to your point about access. And like deposits is one thing, and obviously banks care about deposits, and that's a very important topic that we've been talking about for the last year. But I also think it applies to non-deposit products as well, right? And one of the ones I think about a lot as it relates to banking deserts is a small business lending, right? And as I've written about before in my newsletter, small business lending is one of those things that's kind of inherently irrational, right? Because some small business owner will like walk into your branch and they'll go, "Hey, I need a loan for $20,000." And the banker's like, "Why?" And they're like, "Well, because I have this little bakery, but if I get this new oven, then I can increase my throughput. And there's this opportunity because that other bakery just shut down. And like, I've talked to a bunch of my customers and they're really hungry for these things. And like, this is my moment to expand." But there's nothing about their business apart from the vision that the entrepreneur sees that really justifies that $20,000 loan, right? Like they don't have the cash flow, they don't have the collateral, they don't have the history. So like giving them the $20,000 is kind of irrational. And the only way that banks, in my experience at least, can kind of square the circle on writing that check for $20,000 is to know the community that that bakery is operating in, right? And I think this applies to small business lending, commercial real estate. Like there are types of financial services that involve risks that are way easier to take when you understand the context in which the risk is being taken. And I don't see how those things end up getting replaced easily online, right? And so the thing I worry about, and Montana has a decent number of banking deserts, and I've been to some of the communities that have lost a lot of like sort of their economic viability over the last 50 years in Montana. Some really great places to visit, by the way. And the thing that's really interesting about them is the thing you feel when you're like driving around is there's like a lack of economic like upside and sort of upward mobility that does very much seem connected to there is no one in this community writing checks to entrepreneurs trying to get them to open businesses in this community. And I think when we talk about banking deserts, part of it's like just access, deposits, that kind of stuff, core services. But a big part of it is banks' roles in sort of the local economies of all these communities that they're in. And I don't see how online, national, digital only banks really functionally replace that the way that we have it today. So to me, that's in some ways the more concerning part of it. And I guess branches would be an argument for why you'd want to have some of them stick in those communities.
Yeah. And actually, I mean, it kind of gets also to the point that the Philly Fed makes, which is that, sometimes it seems like the presence of a branch is a reflection of the belief of the economic viability of the market that it's in. And so the Philly Fed, makes the point that, the percent of branches that were lost in low to moderate income areas outpaced the percent that was lost in higher income communities, and that the majority Black areas gained banking deserts at significantly faster rates than the national rate of change. And so I don't know if you're saying that the presence of a branch means there's going to be economic development, or economic activity necessitates a bank putting a branch there to be in the middle of it.
It's a chicken and the egg problem though, right? I mean, I think you're making a really good point that like, it's not the bank closing the bank branch is not a vote in favor of, wow, this is a really strong, economically vibrant community that's just on its way up. Like if that were true, they wouldn't close the branch, they'd open a second branch. And so I do think that on the margins, having a branch in a community versus not does tilt it one way or the other. And, I mean, I'm sure you've been in a lot of these towns in, Nebraska and Tennessee and elsewhere. Like these places, oftentimes, like the viability of a community economically does hinge on a couple of small things going one way or the other. And, a bank branch, I think, can be one of those things. So it does tie back to this Community Reinvestment Act and how that potentially gets modernized. But like, I do think it's not nothing when you close a branch in one of those communities for sure.
Yeah. And I've written about some banks like Midwest Bank Center in St. Louis. They view themselves not as someone who just picks up the economic activity that walks in their door, but as a channel of capital to help revitalize different parts of St. Louis that have received financial disinvestment over the years, and understand that they can be givers and takers, or they don't just have to take the activity and respond to it. That, communities that don't have a lot of economic activity might not be able to support entrepreneurs today, but they work with those borrowers to help them with financial stability or financial wellness and the borrower's borrowing capacity. And then they also, on the other end, find grants that could help the borrower or the entrepreneur. So they really actually do believe that they, as a community bank, can build communities. And I think that sometimes, I hope all banks believe that, but it's hard sometimes to see, what are you doing to strengthen the, entrepreneurs who aren't good borrower candidates today? How are you making them better candidates for tomorrow? What are you doing to help increase home ownership among first-time homeowners? I think about this a lot with first-time college generation, but it's a lot more work to do that. Totally. And you probably will have to have a presence in that community to say that I also believe in this community. And I want, if a bank can put down their flag in a community, that could be maybe a signal to a franchise, to something else, right? That would kind of jumpstart that economic activity. But yeah. Bank branches are weird. It's so weird to be talking about them in 2024.
I know. And it keeps getting brought up. Like I was ready to just be like, branches are dead and just sort of write it off. But like these banks I really respect see a value in branches. And I think there's something there. I just don't know what it is. And one final question I sort of like to noodle on as it relates to branches is, if you suddenly just waved a magic wand and gave any of the sort of large scale fintech, non-bank, digital only providers the ability to just go, okay, you get to steal, like it's Monopoly or something, you get to steal any 5 branches you want from JP Morgan Chase, or not. You don't have to if you don't want to, but if you want to, you can. Like there is none of those fintech companies that isn't taking that deal and swiping those branches. And so it's like, I think just because someone like a Chime or a Cash App or whomever doesn't have a branch doesn't necessarily mean that they wouldn't do branching at some scale in some way, in the same way that Apple sells most of its products online, but it has stores, right? I mean, there's a value to a physical presence post-COVID in pretty much every industry. And I don't think banking at some level is different. So it's just like that optimization right-sizing question is the one that seems to get everybody all riled up.
Yeah. Well, and also I just need to share my favorite new conspiracy theory, which is that Chase opens branches near Chick-fil-A's. And you would like to send me the Google Maps screenshot of your Metro City new Chase branch next to a Chick-fil-A. I will retweet it. This is my new favorite strategy in Nashville. There are at least 5 new Chase branches that are near Chick-fil-A's. So
I like this. I think someone on Twitter joked about this coming up on an earnings call with Chase, but
yes, I was involved in that joke. Yes, I am in that joke.
I feel like with enough focused effort and some help from our audience,
we can manifest this.
Yes.
We can bully JP Morgan into at least opening one location as a joke for
and
us.
I honestly I think if we could just get to Mike Mayo, we could get him to ask Jamie Dimon about this, just because he enjoys sort of tweaking his nose. I really want this to legitimately come up on one of these earnings calls, is ask him about it.
Yeah. There's like a couple more earnings calls and investor presentations for the year. And if someone asks about that in like live, yes, I'll do something. Like I'll do a prize for you.
They definitely, we don't have Bank Nerd Corner swag just yet, but we will make some and send it to you if you make that happen.
Oh, absolutely.
So there's your offer for today's podcast. Kiah, before I let you go, you have a rant that I can't let you just keep sitting with. I need you to like express yourself. So just really quickly, like rant.
Okay. So I'm sure everyone saw that when the Capital One Discover deal was announced, almost in the same breath, there was speculation about whether regulators would approve it. And then it did not take long for people who aren't in the bank space or aren't in the regulatory space to weigh in on their thoughts. And these people are specifically elected members of Congress who are using their public platform to signal to regulators that they shouldn't approve the deal. And I was just seeing this. Like I don't subscribe to a lot of Congress people's websites. So this was crossing into my radar, into the bank space. And the other thing I noticed about this is that they were just reporting that the congressperson was weighing in on this as if it's like a legitimate thing Congress people should do. That Congress should just be telling bank regulators, like, I haven't seen this bank application. It's not even going to be sent to me.
Because it's not my job.
But I don't think it's not my job. I'm not involved. I'm not one of the parties that approves this. But I don't think you should approve it. And I don't think you should approve it. And then for whatever reason they cite afterwards, it is not a reason that is in the Bank Merger Act or it is not in the FDI Act. And I am so frustrated by Congress people telling bank regulators how to do their job when Congress people could make a law that tells bank regulators how to do their job. And this comes up.
Hang on. So you're telling me that people in Congress can pass laws, not just be on Twitter?
They have been known to do it, and they are in fact the only people this country has authorized to do it.
Get out. Really?
Yes, laws. I mean, like, bank regulators can pass rules and regulations, but they can't pass laws. The only people who can pass laws are the elected officials that we have empowered to do that. They actually have this job. They could do this job if they were interested in it. They are, in fact, the only people who can do this job. Something I think is so interesting is when we talk about the Capital One Discover deal, one thing we talk about is that Capital One is actually still allowed to acquire financial institutions because they are under the 10% deposit cap. Well, the 10% deposit cap comes from the FDI Act that Congress passed that said if you are a bank that has more than 10% of the national deposit share, you can't buy another company through a live bank deal. You can only do it apparently through a failed bank deal. Congress did that. That's the rules that we're playing with, right? We're talking about Durbin. We're talking about all the ways that Durbin come up in the financial services space. Why do we have Durbin? It's not that the Federal Reserve decided to have Durbin. Congress told the Federal Reserve to make Durbin happen, and the Federal Reserve decided to make Durbin happen. This is crazy to me that Congress people are weighing in on it. And I genuinely, again, this is my opinion, but I don't think we should be covering it because I don't think it's serious. And I think when people cover what Congress people think other people should do when it comes to their job, we legitimize this activity that I think is bad for society. Like, I genuinely think it's bad that they are talking about this instead of just doing something. And if you wanted to make a law, you are in fact the only people who can make the law. The other thing too, something that's really interesting to me is I don't live in the world where we do this, but I really wish that we could just report on this merger about legally what the application will say and what the laws say about that application. Yep. And I think it's kind of sus. I think it's kind of bad that anyone would say, yeah, but the bank will be big afterwards. I think that there's weight in that, but I think we should stop. We should be really, really honest that I think it would be bad if two banks turned in an application that prima facie on its face should quote unquote be approved. And then it was declined because the bank will be big. And I think everyone should just kind of sit with the kind of logic that they allow in their head that says big is bad, because that's not the rule, the bank regulatory system we live under. We live in this system, but then when we allow someone to say, well, big is bad, or big bank M&A is bad, like that's just not the rules. And that would mean we don't live in a society that is kind of governed by rules that are made in a transparent fashion. And so that is my rant about this bank deal, but also about just people weighing in on things that aren't really related to the application itself and the public laws and regulations banks have to abide by when they submit this.
I could not agree more. I will just sort of heartily add a +1 to everything that you just said. I think that it's wild to watch elected members of Congress, senators, tweet about this. And
yeah, do your job.
Like, okay, so like, first of all, to your point, the argument that like bigger is going to be worse is just not inherently true, right? It's like not inherently true. Now, like, are there reasons why market consolidation might be bad? Yes, but like as others have pointed out multiple times talking about the competitive angle to this acquisition, there's a decent argument to be made that like having another sort of Amex type competitor in the market actually does put pressure on Visa and MasterCard, which is a duopoly, and that does have sort of anti-competitive market power. It actually puts more pressure on them. They're probably not thrilled about this idea. And so like, I don't know how deeply I believe that, but there's certainly an argument to be made that you don't see any of these senators making, that this actually might be good for consumers and might be good for merchants and might actually be good for the level of competition in the credit card space, which, by the way, is not that competitive. Like, credit card is dominated by a few large issuers. This is not really going to change the status quo. And if it does, it probably will make it slightly more competitive. So I find that whole part of it ridiculous. And then to your point, like, it would be cool. I was thinking about maybe offering this. I could introduce Elizabeth Warren, who came out relatively quickly against this, and not unsurprisingly, given her background and kind of how she thinks about the world. I could introduce her to her colleague, Josh Hawley, who's a Republican from Missouri, who also came out using shockingly similar language, urging the Biden administration to stop this merger from happening because it would harm consumers and it would disadvantage financially vulnerable consumers. Like, they're speaking in exactly the same language. They clearly see the problem in exactly the same way. Now, again, not maybe the way I would see it, but I'm not an elected member of Congress. They are. And like, all they have to do is put their heads together and propose a bill. It sounds like they actually might be able to get it to pass. But like, instead of doing that, they tweet about it. And it is truly bizarre. And, federal regulators can't kind of come out and like bitch about this. So we'll do it on their behalf. But it would be super annoying to be like, okay, this is my job. I've got it. I'm aware of all your concerns. I know what the law is. I mean, just to use the acting comptroller over the OCC as an example, like, he's spoken recently about bank mergers and sort of laid out his views on it. Like, clearly they have an approach they're going to take that's going to follow the laws, and there's a process to do this. Don't weigh in from the sidelines, especially when you're like the coach of the game. It drives me crazy.
Well, the other thing too, and like, again, we just really need to say and underline, Congress created Durbin. Capital One and Discover are responding to the incentives that the Durbin Amendment creates and the exemption that the Durbin Amendment created. And they're like, I don't understand why Congress doesn't understand that it had a role to play in the frame, in like the incentives and the lay of the land that these banks are responding to. And then they're mad when banks respond to the incentives. And then they're saying it's anti-competitive. And it's like, you made this whole thing. If we got rid of Durbin tomorrow, maybe the deal still goes through. I don't know. But it would be like maybe a lot less interesting, or they would pay not as much, or I just can't like get over the like sideline. Like, and I don't know, man, as a soccer referee, like, I think I'm like extra triggered by people who
this is like parents like shouting at the referee in the game. It totally is.
And so, or like someone yelling at me and then me being like, I didn't make the rules.
Right.
Like, I have to call this and I didn't make the rules. If you care about this, you could get on a rules committee or whatever. And like, to just say like, man, like, this is not yelling at the refs to like make a call is not this is bad in all the places. It's bad in Congress and it's bad on the soccer field. And I think that I don't think Congress should make a rule, because I don't think Congress is like that good sometimes at financial regulation, aka Durbin.
Yeah.
But they could do it. That's what they could do if they were so moved.
100%.
So,
no, I couldn't agree more. I mean, to put it in a basketball analogy, because I'm enjoying the NBA right now because my Boston Celtics are really good. This is absolutely like if Adam Silver, the commissioner of the NBA, was like sitting in the stadium and like yelling at the refs during the game. And it's like, you're in charge of the refs. What the hell are you doing? Like, this is crazy. Yeah. And so, no,
you can change the rules.
Anytime you want,
you don't need to yell at the refs to change the rules.
Yeah, it's like,
just change the rules. Don't follow the rules.
It's wild. Yeah. It is absolutely wild. So no, I could not agree more. Yeah, I don't think there's any members of Congress who listen to our podcast, but if they'd like to come on and debate this point, we'd be more than welcome to have them.
They're just a private person, though. That's the thing, is they're acting as if their opinion counts more, and that they're bullying. Like, my bully pulpit only counts for so much too. Like, we're trying out here to bully Chase into building more branches near Chick-fil-A's. Like, but I'm just a private citizen. Like, I'm not doing this as a financial personality. I'm doing this as, someone who just wants to live in the world where this happens. But yeah, I think everyone should do their job and then also stay in their lane.
I totally...
except for podcasters, because, this is what we do.
This is our lane, Kia. This is our lane.
This is our lane.
Okay, well, that's a perfect place to leave it. As always, Kia, this was a delight. Thank you so much. Hopefully, I will run into you in person at one of these conferences that we're both able to go to. And until then, we'll be back at it next month. Thank you again.
All right, thanks.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.